Welcome to Made in Italy CEOs. Our conversations are usually in Italian with Italian and English subtitles. In fact, a couple of days ago I published this special episode in Italian, but today I thought it would be a good idea to record it in English as well. So there it is. Since we launched this channel in December last year, we have published 13 podcasts, 13 conversations with extraordinary businessmen and women, as well as one with a special MP, who have told us about their vision, their journey, and the challenges they have faced. In this episode, I want to share with you the main common points that have emerged from these dialogues. Ideas, convictions, and reflections that return punctually in every conversation. The first point, very strong, is the value of the stock exchange listing. All the CEOs we spoke to emphasized with great conviction how the listing is a crucial moment and a turning point. The benefits are clear and heartfelt. Access to the capital markets, greater visibility and reputation with customers, suppliers, and even employees. And then there is the discipline, the organization of internal processes, the continuous feedback, sometimes uncomfortable, but always useful, that comes from the market and investors. Those who embrace a quotation do it with conviction, and they experience this step as a milestone and a point of no return. Second, being listed is not easy. In addition to costs, initial and maintenance costs, one needs structure. One needs an organizational machine capable of communicating, telling people about the company, generating and maintaining the interest of investors. And here, size matters. Large companies, especially those in the MIB 40 index, benefit from automatic visibility. Italian funds tend to stay around the index, and even international funds dedicate a small but stable part of their portfolio to Italian large caps. Small companies, on the other hand, have to find their space. In a market crowded with companies of a similar size, they have to make their mark. They have to build their audience. Third point, the thorniest. Who really invests in SMEs, in small and medium enterprises? In Italy, investors who seriously focus on SMEs are few. It is a global trend, surely. Why risk on a small, unknown company when you can invest in Google, Microsoft, or Apple? Or in Italy, in Unicredit, Ferrari, Leonardo. When it comes to talking, everyone praises SMEs, the backbone of the Italian economy. When it comes to putting money in, many back out. Too risky, too illiquid, too obscure. There are also those who trivialize the problem and say, if a company is good, it will find investors sooner or later. But this is a tautology. Every public company has investors by definition. But that is not the point. The point is that there is still a strong cultural prejudice against the public market in Italy. People prefer the private market, even though, paradoxically, it is riskier, more opaque, more illiquid. It is precisely this mentality that has held back our stock market, which for a long time has remained under the control of a few big families, cozy relationships, the so-called salotto buono, with their Chinese boxes, with small savers there as passive spectators. We have made significant progress on this, but the lag compared to other markets, such as the UK, France, Germany, remains. How then? How do we build a more efficient, fairer, more business-friendly capital market? The answer is simple, at least in theory. By encouraging, incentivizing, and facilitating companies to list on the stock market. In this we have made great progress, especially in the last 5 to 10 years. We have seen a steady increase in the number of listed companies, particularly small companies, choosing to quote on the Euronext Growth Milan market, the EGM. This is a first step, often thought as a preparation for a future listing on the main Euronext Italy listing, once the right business and organizational maturity has been reached. And this has been possible thanks to an ecosystem that works. Brokerage firms, consultants, law firms, advisors, all coordinated with the central support of Borsa Italiana. A system that leads companies along the path to listing up to the moment of the IPO, the initial public offering, when the company opens up its capital to investors and begins its adventure as a public enterprise. From there, anyone, funds, institutions, but also small savers, can buy shares and participate in the company's growth. But that is not enough. After the IPO, the company is indeed public, but only a portion of the shares, the so-called free float, often around 20% for companies listed on EGM, is actually tradable on the market. And here comes the crucial point: liquidity. For the market to work, you need a large and active base of investors willing to buy and sell. Without this base, there is no volume, no movement, no prices that truly reflect the value of the company. Liquidity is like oil in an engine. Without oil, the engine stops. So, just like for companies, investors need incentives, stimuli, tools to help them look beyond the big names, to invite them to invest in listed SMEs. And here we have a concrete and virtuous instrument, the PIR, the individual saving plans. Launched in 2017, PIR funds have had an extraordinary initial impact. Almost 11 billion raised in the first year, equivalent to 1/6 of all retail inflows. In 2018, another 3.9 billion, including 3.3 billion in the first half of the year, despite falling markets and significant redemptions elsewhere. The original PIRs had simple rules. At least 70% invested in Italian stocks, and of this, at least 30%, that is 20% of the total, in companies outside the MIB 40, hence in SMEs. And the incentive was very strong, and still is: complete exemptions from capital gains taxation if the investment is maintained for at least 5 years. We are talking about 26% saved on considerable gains, a concrete, tangible advantage. Those who claim that these instruments are artificial or public welfare are wrong. There is nothing interventionists about PIRs. They are pragmatic measures aimed at correcting real market dysfunctions and leveling the playing field. They are instruments that do not distort the market. They make it work better. And this is a benefit for everyone. The companies that find capital, the investors who get returns, the operators who see the market grow, and the entire Italian ecosystem, which becomes competitive, more modern, more open. In fact, the creation of peers had a clearly positive impact on the Italian stock market. Their launch accompanied and in part fostered the wave of IPOs that continued in subsequent years. According to data from Assogestione's Peer Observatory, by the end of 2022, peer funds promoted by the association's member companies had reached a total value of almost 19 billion, of which 17.5 billion in ordinary peers, those that we just described, and 1.5 billion in alternative peers, which we will return to shortly. Looking inside ordinary peers, we find that the investment in Italian equities amounted to 8.3 billion, broken down as follows: 3.7 billion in mid-40 stocks, another 3.7 in mid-cap, i.e. the next 60 stocks in terms of capitalization, and finally 0.8 billion in small caps, of which 0.5 in the main market and 0.3 billion in EGM. So, although the idea of peer is often associated with listed SMEs, the reality is different. At the end of 2022, in fact, small cap stocks accounted for just 4.6% of the total value of ordinary peers, and to 9.6% of the total invested in Italian equities. The observatory also estimated that the total value of the free float, i.e. the small cap stocks not held by controlling shareholders and therefore available on the market, at around 9.5 billion, 5.9 billion on the main market and 3.6 billion on EGM. In this context, the ordinary peers held about 9% on small cap float, an important share, but certainly not predominant, certainly not so large as to make them too cumbersome as investors. So the real merit of peers was that they created a new category of funds partially focused on listed SMEs, and this gave a real boost both to the emergence of new IPOs and to the liquidity needed to support them. Unfortunately, however, the mechanism jammed already in 2018. That year, a regulatory amendment driven by good intentions but lacking in design and implementation, as Mr. Centemero himself also mentioned in his podcasts, effectively blocked new subscriptions. The proposal was to raise the share of non-MIB investments to 40%, adding two new constraints. The first, at least 5% in EGM stocks, and the second, another 5% in venture capital funds. Surprised by the unexpected change and waiting for the new rule to be enacted, peer funds suspended subscriptions, signaling the difficulty of adjusting to the new constraints. So at the end of 2019, in view of the rule's lack of applicability, the legislator backtracked, reinstating parameters very similar to the original ones, at least 30% in non-MIB stocks, and of this, at least 5%, that is 3.5% of the total, in non-MIB and non-mid cap stocks, i.e. in small cap stocks listed both on the main market and on EGM. But by that time, the damage was done. in 2019, peers not only raised nothing, but recorded net redemptions of 1.1 billion, despite a year of very positive performance for the market, particularly in Italy. Then came the pandemic, and even when the market rebounded in the second half of 2020, with total inflows of almost 18 billion, peers remained stuck. In fact, there was another 0.8 billion in redemptions, signaling an unexpected recovery that never came about. In the meantime, alternative peers were launched. This was an important novelty. These funds stipulate that the entire 70% invested in Italy must be in non-MIB and non-mid cap stocks. That is 20 times as much as in ordinary peers. In theory, this was perfect. In practice, however, there is one detail. Alternative peers are designed to invest primarily in unlisted stocks. And this changes everything. Because while on paper these funds could have supported listed SMEs much more effectively, in reality, they did not and do not contribute to the growth of the stock market. Their focus on unlisted securities makes them irrelevant to the goal of expanding the size and liquidity of the stock market. In this, our Made in Italy fund, which is an alternative peer fund that invests only in listed stocks, is an exception. So by 2021, peers seemed a faded memory of the success of 2017. No new subscriptions, only 0.3 billion in ordinary peers, and just over $1 billion in alternative peers. And mind you, we're talking about a year in which total fundraising in Italy was almost 58 billion. What is striking is the paradox. The stock market, especially in Italy, was doing great. Mid caps and small caps were flying. The EGM index, which had closed 6% in the red in 2019, was exploding 58% in 2021. Yet, no peer subscriptions. Why? A simple explanation is that after the regulatory confusion and the pandemic, the interest of advisors and savers was lost along the way. But it is a convenient and superficial answer. Another hypothesis is that the peers had already saturated the small cap market, but this too does not hold water. We have seen it in the numbers. There was still plenty of room. And there was also a good flow of new IPOs. The real problem, the structural one, is another. It is that investments in ordinary peers are concentrated in a few large funds. And when a fund is too big, managing small caps becomes a nightmare. Difficulties entering and exiting positions, liquidity problems, and increasing risks under the watchful eye of internal and external regulators. But the worst was yet to come, namely in 2022. After the first 5 years since the launch of peers in 2017, 5 years required to obtain the tax exemption. And that is where a massive wave of redemptions started. 700 million in the second half of 2022, 2.8 billion in 2023, and in 2024, which is not seen in this graph, another 1.9 billion, almost 2 billion. What is the crucial point here? Is that these redemptions were not necessary. The law is clear. It says that after 5 years, the exemption is obtained, but it does not say that one has to sell the fund to get it. And what happened? Instead, off with redemptions, often on the basis of clumsy advice, with results of forced sales, pressure on smaller stocks, prices down, and funds forced to liquidate the most illiquid positions. The most serious damage was that many of these companies, crushed by the fall in value of their stock, had to revise or upset their strategies and investment plans, the very plans they had presented to investors at the IPO stage, counting on their support. The numbers confirm it. Since July 2022, 100 euros invested in the MIB 40 index has become more than 200. In small caps, barely 105. And in the EGM, actually down to 85. And even the STAR index, once the pride of Italian mid and small cap stocks, in the last 2.5 years went down the same way. The performance gap is astounding. So let's recapitulate. Redemptions could have been avoided or at least managed better. 2, asset management companies could have limited the damage by not selling small caps, as the percentage of small caps in their portfolios was quite limited. And 3, alternative peers, if invested differently, could have absorbed at least part of the impact. But this was not the case. Now, let me be clear. I'm not saying that it's all the fault of peer redemptions. The underperformance of small caps is not just an Italian anomaly. It is a global phenomenon, which started in 2022 and is still ongoing. What I'm saying is that in the Italian case, those redemptions amplified the damage. They made it more acute, more unjust, more difficult to explain. This graph shows the difference in performance between the large and small cap indices of the euro area, including Italy. The graph explains part of the Italian gap, but only about 1/3. The rest, it's all our own doing. Besides, not all small caps were affected in the same way, of course. Take Circle, for example. In the midst of the storm, the stock doubled in price. We talked about this in the episode with the CEO Luca Batello. And then there is Cembre, General Finance, the Italian C Group, Expert AI, Reway, ECOP, all stocks that we invested in, we believed in, and did well. Many others, such as TXT, FOPE, Italian Exhibition Groups, Eviso, these are stocks that we did not hold in our portfolios, but also did very well. And then there are those that we had and that exited the market. Reno de' Medici, Labomar, Piteco, Finlogic, Beer, and others, all through public offers with significant premiums. But the numbers speak for themselves. Most small caps, and even more so those in the EGM market, posted negative performance, or at best stagnant performance, and thus far inferior to the performance of large caps. Again, of course, not everything is attributable to peers. Some companies simply did not do well, including some that we invested in. Others failed in communication. For small companies, we've seen getting noticed on the stock exchange is a daily struggle. But in so many other cases, and we've seen a few in our podcasts, those collapses had nothing to do with fundamentals. The forced sales overwhelmed even fully growing companies. And this is where the tautologists reappear. Those who proclaim, oh, but the market is always right. Well, try telling that to Christian Travaglia, the CEO of Identity, the first guest on our channel, who said, "We have doubled and tripled revenues and profits, but the stock price is still there, stuck around the level it reached just after the listing. A disappointment that makes us question whether we should stay on the stock market." This is why I do my job. It's because I believe that the market is not always right. It was with this belief that the Made in Italy Fund was created back in 2016, with a clear objective: to invest in Italian companies with a capitalization of under 1 billion and find those where the real value far exceeded the market price. Invested in tomorrow's stars was and remains our motto. The fund got off to a great start. Already at the end of the first quarter of 2017, we were up 34%, more than any other fund in the Italian equity category. Lower volatility, better risk-return ratio. And by the end of 2021, 5.5 years after the start, our goal was fully achieved. Returns more than doubled, NAV from 100 to 215, with less volatility than the other funds. Only 2 funds had done better, both linked to the star index, which was okay. We were aiming to discover the next stars. Then, however, everything changed. 2022, inflation, rising interest rates, war in Ukraine, markets crash, then rebound. But while the mid-40 recovers, small caps do not. On the contrary, they continue to fall, down 3.3% in the second half of the year, against plus 13% for the mid-40. In 2023, the gap becomes embarrassing. Mid-40 plus 23.3%, small cap plus 0.3%, and the EGM even minus 2%. And then we begin to realize peer redemptions are doing serious damage. We denounced this in a document in which we propose a relaunch of peers and a fund of funds for institutional investors. But it's too late. Even 2024 ends in the negative. I look back and I ask myself, could I have done something different? Well, yes, with hindsight, yes. I should have sold the most illiquid positions, gone back to solid mid-caps, Sol, Luve, Banca Ifis, Technogym, stocks in which we had invested before we focused more and more towards EGM. Maybe take advantage of the possibility of peers to invest up to 30% in other stocks, to buy large cap stocks as well, even outside Italy, even Apple or Nvidia, why not? But we didn't, for 3 main reasons. 1, we wanted to stay true to the original mission of the fund. 2, we underestimated the extent of redemptions. And 3, we could not accept the idea of participating in the forced sales. What's the lesson here? The lesson is that there is a fine line between resilience and stubbornness. Skin in the game is good, flesh in the game is not. The result has been 3 years of negative returns, a compromised track record, and a fund which today is struggling to survive. And on this sad but honest note, I conclude this talk with the hope, never more so than today, of better times ahead. The premises are there, starting with the fund of funds proposed in 2023, and which will finally see the light of the day this year, thanks to the effort of Mr. Centemero, of Undersecretary Federico Freni, and many other players who have worked hard to turn this proposal into reality. And then there will be work to be done on AT Fund, a market managed by Borsa Italiana for the direct purchase and sales of independent funds, and so far still little used. But we will talk about this in a future episode. I close with the usual notation: nothing we have discussed, all the more so in this episode, should be interpreted as investment advice. Thank you for your attention, and see you soon.